Hey guys, how's it going? It's Andy from MagooInvesting. Happy Wednesday. I know I haven't made a video in like a month and a half. We're going to talk about that in a little bit, but I do want to start off the video kind of talking about the elephant in the room, the fact that I'm wearing AirPods for a video. The fact that my phone is kind of like a year and a half, almost 2 years old, you start having some problems when you use something on a regular basis, every day for more than a year. With my last phone, it was a problem that the battery always had problems and it would only charge from a specific angle. And with this phone, I'm having similar problems. And one of the results of Apple's kind of design strategy is that the way that I would be recording the audio is the same way that I would charge the phone. So what that means is that the old way of recording videos wasn't possible anymore because I had some problems in the past where I would plug the audio connection into the phone, and then halfway through the video it would cut out and it would sound horrible. So using AirPods is going to be my way of kind of fixing that going forward, and I had to buy one of those, like the pads that you put your phone on top of to charge. Still don't really understand how it works, but that is the way that I'm going to be doing it going forward. In today's video, I'm going to be talking about 3 main points, and timestamps are going to be in the description, also pinned comment, because I know a lot of people are interested in specific parts of my investment strategy, and I'm going to try to hit on all of the major aspects of investing that I haven't talked about since I made my last video, like a month and a half ago. So part 1, I'm going to be talking about the low volatility that we've been seeing in the overall market. I'm going to talk about the things that I bought recently to take advantage of this low volatility, talk about some of the option strategy plays that I've been looking at, because for the past year and a half, when volatility has been so high, one of the benefits of it is that the premiums that are going to be bringing in on each option trade is a lot higher than what we've been seeing right now. So I'm going to talk about what I've been seeing as potential interesting option plays going forward. Then number 2, I'm going to be talking about how I kind of distribute my money for, the difference between my long-term investments and my retirement accounts. Because at this point, I do have a normal investment account that I use kind of as a savings account, and I have a retirement account, a Roth IRA, and I'm going to be starting a job relatively soon that's going to have a traditional 401k. So I'm going to talk about kind of how I'm deciding where to allocate the funds, because I think that's a very important thing to make sure that you kind of have an understanding of what's the best way for you to do it, and is it worth kind of being a little bit more aggressive to try to maximize your gains. And then part 3, I'm going to talk about kind of what I'm looking to buy going forward, because as the market has not been as volatile, you don't get these great buying opportunities. So I'm going to talk about what I've been buying recently, kind of what my view on the market is going forward, and how I'm going to be trading some relatively risky positions, and kind of the deciding factor for why I decided to buy in and when I'm going to be deciding to sell when that time eventually comes. So as always, got to say, this is not financial advice, and let's hop right into it. So let's talk about volatility, because the classic way that I like to kind of look at volatility is by looking at the VIX. The VIX is an instrument that gives a numerical value to the overall volatility that we've been seeing in the overall market. And since the pandemic started up until very recently, the entire time it had been above 20. 20 is historically high on the volatility side. I think when I started getting involved with the stock market, it was sitting around 15, which was decent enough, but it wasn't super attractive. And in the past year and a half, I'll pull up the VIX right now while we're talking. It has just been incredibly low. It is currently sitting below 16. When I go to the 5-year in March of 2020, it was at 66, and it is pretty much continually fallen. And you've had little spikes each month that is given some fantastic opportunities, because as I mentioned, as volatility spikes, premium spikes, because volatility is that the expected move up or down is higher than normal. And so that is one of the ways that option prices are kind of calculated, and it's a way that you can take advantage of that. And so at a time like this, where volatility is low, it makes using the wheel strategy not as attractive. The wheel strategy, for those of you who don't know, is a way that I've been kind of using options to try to maximize my gains and try to limit my downside potential. Kind of the TLDR of it is you sell a cash secured put, meaning that if the stock falls below your strike price, you're on the hook to buy 100 shares of that given stock. And the reason that you're on the hook for that, and the reason why we want to do that, is because you're pocketing a premium. And if the stock, by the time it gets to expiration date, is above that strike price, you just get to pocket the premium. And so when you have high volatility, you're going to be making a lot off of those premiums. And if it's a stock that you really like for the long term, I have no problem buying 100 shares. And if you do get assigned, you do the same thing to the upside with a covered call. And with a covered call, you are limiting your upside potential, because you're basically selling a contract saying that you're fine selling at this given price, and in exchange, you're going to be pocketing this premium. When volatility is low, it's not as attractive to be using this wheel strategy, because likely the stock is not going to fall significantly, but you do have the potential that if the stock skyrockets, you are very much limiting your upside potential. And so I've been seeing a lot of articles recently on subreddits like Theta Gang, which is kind of the mindset that I use for trading options, is that in most scenarios when volatility is not very high, just buying and holding is the best way to maximize your gains for the long term. And so as of right now, I only own one options position. That is the LEAP that I bought for GE that expires in January of 2022. It's getting to the point now where I believe it's down around 20%. And you might be wondering, wait, I thought GE's been doing great since you bought that position. Yes, it has, but part of the, as I mentioned, the way that option prices are calculated is by looking at the volatility. And since volatility has fallen, it has fallen faster than the stock price has gone up. So that's why I'm down around 25% on this like $100 position. So not a huge deal. I likely will exercise it if it does end up in the money, even if it does result in a small loss. But as of right now, I'm not using any wheel strategies because I personally think that it's better to just kind of buy and hold right now. And it's not as exciting. We've had a lot of people, I've noticed specifically on YouTube, some of the YouTubers that I've followed for a long time have slowed down on the types of videos that they've been making because there's not a lot going on with the overall market. And for most people, that's actually a great thing. For a lot of people getting involved in the stock market, they don't want to have to check it every day. In a situation like this where the stock market just kind of goes up and down by 0.5%, but it is constantly chugging up, I think it's a very beneficial thing. And that is why I decided to buy TQQQ. This is a 3 times weighted ETF that follows the NASDAQ. And in a situation like this, I think this is one of the only times where I'd be comfortable holding this for the long term. With leverage ETFs, you have the risk of, if the stock has large jumps up or down, you're going to have decay. And this is a problem with leverage ETFs, is that when you have large moves, the resulting underlying stock is going to have problems for the long term. I usually only talk about this when it comes to the inverse, which is SQQQ, which is betting against the market. But for something like TQQQ, I've talked about in previous videos that if the S&P 500 goes up 1% and then goes back to where it started, it's possible based off of the differences in prices, based off of the weighting, that you're not going to be break even. But in this situation, I've done very well since I bought in, I believe I'm about 15% overall, when the overall market is only sitting up around like 3%. So I've been able to kind of maximize my profits off of this by taking a slightly riskier position. It is still only like 5 to 10% of my overall portfolio, so it's not that big, but it is a riskier position than I would normally have. Now let's talk about the difference that I use between my long-term investment account and my retirement account, because some people, when I say this, are going to be kind of confused. I use my retirement account as my risky portfolio. And the reason I do that is because it is protected from taxes. I use this as my risky portfolio for specifically selling options, because when you sell options, you are bringing in cash that goes into your account. If this was in a traditional investment account, you'd have to be paying taxes on that. So I like to use the wheel strategy in an account that is protected from having to pay taxes. That's kind of the whole point of using these, specifically a Roth account, is that you don't pay taxes because the money that's gone into it has already been taxed. So I use my retirement account as kind of a riskier investment kind of portfolio. And now that I'm going to be starting a traditional 401k that is not protected from the taxes, I'm going to be using that traditional 401k kind of like how I would be using my normal investment account. The way that I use my normal investment account is I use it as a savings account. With interest rates hitting pretty much zero, I was paying more in fees per month than I was going to be making based off the interest. I haven't done the math on it, but I was paying like $5 a month for Bank of America to have a savings account. You don't need a savings account. So I just moved all of that money into my normal investment account. And so I've been holding this all for longer than a year. So I get the tax benefits of, if I do need to sell, I don't have to pay taxes on the gains that I've made. So that's beneficial in that aspect. But one of the things that I think is very important to understand is with this method, there's a lot more risk. If you put your money into a savings account, there's no chance of it going down in value. Even if interest rates hit zero, you're not losing money. Half of my safety net, I have half of it sitting in a normal investment account, and half of it is sitting in my Bitcoin. With Bitcoin, it looked great like 2 months ago when I was looking to potentially buy a car. I had a potential job opportunity that was going to be on the coast, and I would need to drive an hour and a half each way, 5 days a week. My current car wasn't going to do that, so I was looking to potentially upgrade to a car that would, be able to handle that type of drive. It was great trying to kind of guess how much money I'd need to save to make that happen. But then when Bitcoin drops from, like 60,000 down to like the mid 30s where it's been hovering for a long time, it makes it very difficult to plan for the future. So I think it's very important to understand that Bitcoin is a long-term investment for me, but I need to understand the high volatility of the underlying product that I'm owning makes it so it's very difficult to plan financially for what I'm going to be doing going forward. So that's kind of how I look at the difference between those. I'm not going to be taking the Bitcoin out unless I absolutely need to. The order of kind of ways that I go is I keep enough money in my checking account to pay for 1 month's worth of expenses. Then I have around 2 months worth of expenses sitting in my normal investment account. And then I end up having like 3 months of pretty much payments or how much I'd have to spend on any given month sitting in Bitcoin. That's my like last ditch effort, where if I was very desperate, that's where I'd be taken out of. And in part 3 of this video, let's talk about what I'm looking to buy right now. With the market not being super volatile, you don't get a lot of big moves in the overall market that makes things very attractive. I ended up buying into Lululemon and TQQQ. Lululemon is a stock that I've been talking about potentially buying for a long time, and I thought this was the time to finally buy it. So I ended up buying that. I am going to be looking to buy more Bitcoin as it's been dipping. It's been able to hold the 30,000 mark for a long time. So when I get my next paycheck, most of that will probably be going into Bitcoin. When I look at renewables have been hit pretty hard in the past 6 months. This is a type of my portfolio that I'm very strongly opinionated about. And when I bought in January, definitely was not the right time. I definitely made videos talking about how this was an emotional buy. And now we're getting to the point where my positions are only down like around 10%. And I had like 20% of my portfolio sitting in cash the last time I made a portfolio video. And it was very tempting to average down in a position like this. But I thought it was very important to try to diversify my portfolio slightly. This is my retirement account that I have described it as being volatile. But I don't want all of my eggs in one basket, especially with renewables that have been hit pretty hard in the past like 6 months. So I ended up buying some TQQQ, bought some Lululemon. I added to my blue chip stocks, stuff like Microsoft, Apple, Nike, and then I think I bought some SPY, which is just a generic ETF that follows the S&P 500, which is only up around 3%, but it's better than just sitting in cash. So as of right now, I am looking to buy the dip on any of my stocks that I own that have significant drops as a result of earnings. So I have alerts set on all of these stocks that I own that's around 5% below where they're currently trading. And if those ever get triggered, I'll go on to the TD Ameritrade and make a decision based off of that. So that's kind of the third thing. I'm just kind of looking to buy anything that I see as a good opportunity. The market's been very flat. It's been going up, but it's been relatively flat. So I think it's important to kind of keep an eye out on stocks that you'd be willing to buy if things do happen. So I want to talk about some of my personal life. I'm still living in Portland. We just survived 115-degree heat. I have been working at a gym. It's been all right, not the worst thing in the world, but I'm hopefully going to be getting into a career job in the next week, which is very exciting. I'm going to be trying to post more often because I do really enjoy making videos, but as I mentioned, the problem with the charging port made things very difficult because I wasn't able to get good audio, and I recorded a couple of videos that just ended up sounding horrible. So I waited until I got these AirPods, and now hopefully the sound quality sounds a lot better. So let me know if you guys have any questions about my life, how I'm going to be using my investment portfolio going forward. And let me know if you just have any stock picks that you're curious about in the comment section down below. Thanks for watching. I appreciate all the support, and I will see you in the next video.